Okay, the first addendum we're looking at right here is a short sale listing agreement, agency disclosure on short sale. Okay. Anytime you're involved in a short sale, it has to be disclosed all throughout the transaction. There are some unique aspects of short sale that, from a seller and buyer perspective, that both need to know, and that's what this goes through. I love the nickname short sale because they do not go in a short amount of time. Right, Ryan?
Yeah, I haven't done any personally, but yeah, I understand they're very, they're more complex inside. Yeah.
7 years ago when I started, 7.5 years ago, my first couple, had 2 short sales in the first year. And one of them took so long to get the third party approval that she was already getting ready to write other offers. And it was a large member of the banking industry that eventually paid billions of dollars in fines for the way they treated their clientele that we were waiting on.
I think I know that.
Yeah. So there are some unique aspects of short sale that this has to explain. First of all, is that the seller has to acknowledge that the seller has received this disclosure, that they know that this is what's going on, and that there's a third party approval process. Now, the third parties, are you familiar with it? Just, are you familiar with the third party approval process for short sale?
Refer to the lender approving, is that what you're referring to?
Yes.
Yeah, I'm familiar with that. I just put it in the end.
Yep. You've had to look at them as an underwriter. You know that whoever the lender is has to approve the contract and the sale.
They approve like almost the amount that's done, almost 10.
Mm-hmm.
Yeah.
Basically, how much is the lender willing to lose on the deal?
Yeah.
Is kind of what it comes down to.
And they have the lender the other two lenders.
And so, and this gives because the third party is essentially agreeing to lose money, it gives them some power and they can impose some requirements on the transaction. And the seller has to be aware of that. The 3 primary ones that it begins with here is that the third parties may choose to obtain a broker price, opinion, or appraisal if they don't agree with the appraisal value that comes in. They can require the seller to demonstrate what the financial hardship is. Why is the short sale occurring? And they can require the seller to provide copies of tax returns, assets, and other forms to verify that they are in a financial difficulty. Now, as the market took off the last few years, we saw fewer and fewer short sales just because market equity had kicked in. But now we're starting to see where people bought in those, yeah, I'll offer you $20,000 over asking price, when asking price was already extremely high. And over the last 8 months, we've lost 10% of market value. So you overpaid for the house to start with, and now it's lost 10% of value. The seller has to authorize some specific behaviors in the selling of the process. All of it has to be advertised and marked that it is a short sale. And letter C here is specific. The seller takes an offer in from a buyer and accepts the offer. That's not done yet. The third party still has to approve it. And until the third party approves it, the third party retains the right to maintain that property on the market. And if the seller receives another offer that is more favorable to the third party can reject the first offer.
Which is listed as active time clause.
It's typically, well, it's listed either as active or time clause, where it has to show that it's what it actually shows in the MLS on our MLS is that under third party review. So it's active under third party review. That means the seller said yes, but the third party still reviewing. I've had that happen once where we had already had the buyer and seller negotiated everything, signed everything. It went off to the third party. And about a week later, I got a call from the seller's agent saying, we just got another offer. He said, I can't tell you what it is because the third party won't let me disclose it. But what I can tell you is this is how much we're going to net from the sale. Do the math. So I called my client and said, here's the situation. We did the math, figured out where the other offer was, added a couple $1,000s to it, and sent him an addendum updating our offer. Because it was still well within what he qualified for. It was still well within what the market would hold on the property. We just had to update our offer in order to keep it going. Now, there is a misconception on whether or not you can purchase a short sale using FHA and VA. You can, as long as it still meets FHA and VA requirement. The seller acknowledges a lot of stuff on this that they legally have to know. Part 4 is really where we start to deal with the numbers. Again, this is the addendum that goes on the listing agreement, so they know what's going on listing wise. They have to understand right here that they may not receive any proceeds at closing. If it truly is a short sale and they're selling for less than what's owed, they're not going to get anything. Now, the last couple of years, I've seen maybe one short sale a month come up. And I had a client was interested in one and they'd already received 5 offers, all of them over asking. So even though technically it was a short sale because they were originally listing below what they owed, there was the potential for them actually having positive equity by the time they were done. Now, in the event that there does actually turn out to be positive equity, they can receive that back as the seller.
Question, if they get an offer that would give them positive equity, they don't have to go through the short sale process?
Still, because it's listed as a short sale and began that process, unfortunately, it still has to go through that process. Good question, Ryan. Yeah, even though there's positive equity on it, it still has to be approved by the third party. Because the third party is going to look at it and determine whether or not the third party could actually reject an offer that looks really good if they determine that the market's not going to bear that price. If it's a short sale at 350 and somebody comes in offering 450 and the median sales price in the area is 370, the third party may reject it because they don't want to get weeks down the line and have it not appraised and then have somebody walk away from it.
Yeah.
Third party, and this I learned from my brother, the accountant. Initially under Utah bankruptcy rules, once short sale, you walked away from it, you were basically were absolved of the deficit. Well, when the market crashed last time, Utah was one of the short sale capitals of the nation. We got beat by Vegas, but banks were losing so much money that the state requirements over bankruptcy were changed, and the bank or the third party lender can now hold the seller liable for the deficit. In other words, if they owe 400 and the bank allows them to short sell it at 375, and you take out all the closing costs and everything else, and their deficit then ends up to be about $50,000, the third party lender may still hold them liable for that $50,000 deficit. It can be difficult to collect because they just short sold the property and they're probably heading into bankruptcy.
Did the lender put a lien on the piece of property to get it?
No, that is one aspect of the short sale that protects the buyer, is that that deficit is a debt to the seller. But it is something to consider. The property may still actually go into foreclosure. The lender still has the right if the process is taking too long to foreclose. My experience has been it was an average of 6 weeks to get third party approval. When Marty had a listing, however, when the market went soft the first time, and it was 8 months to get the short sale approved. lenders didn't want to do it because they were going to lose so much money. They'd rather somebody stay in the house and not even make a payment and wait for the market to rebound. Because once it goes into foreclosure, that's where, if you remember from 10 years ago, the term toxic asset was being thrown around. Because most of the third-party lenders, then their investors give them a deadline to get rid of the property because they're not making money on it. But once it's gone into foreclosure, you've added all the legal costs. Which is right, as you know, once the legal costs get involved,
Yeah. It's something.
gets expensive fast. These are all covered in, all of these kind of things are covered in there. There are other legal financial options that a seller may consider. Loan modification, refinance, bankruptcy, foreclosure, deed in lieu of foreclosure. They need to be aware that there are other options. Each of those will have a different detrimental effect on their credit and their ability to purchase in the future. The most forgiving of short sale or foreclosure is the VA. Because many active duty will purchase a home knowing they'll be at this duty station 36 months, but the longest for most enlisted. If you're an officer or if you're in a unique specialty, you may be there longer, maybe 5 years. But if you buy it at a zero down and you don't get enough market equity in 3 years to cover the loan and all your closing costs, you may find yourself upside down. So the VA is more forgiving. And the VA does allow short sale of a home that was purchased with VA. The brokerage fees referenced in this listing agreement are subject to third-party approval. So we sign the listing agreement with a 6% brokerage fee. The third party has the right to change that. If that 6% is going to cost the third party too much money, they can say, no, 5%.
Do they normally knock it down a lot?
It may happen, but we do have to post on the listing that in the event of third party, the third party requires any change in the commission, it will be split evenly between seller and buyer brokerage.
It has to be done that way.
So say we start at 6 with a 3% split. The bank says you can only do 5, then we're dropping to 2.5%, and the buyer gets 2.5%. And really, there's not a lot of recourse for the buyer agent to try to get it out of the seller at that point, because the seller isn't the individual, it's really the third party. As usual, it always says seller is advised to consult with legal counsel. Because the legal counsel is going to help them understand the contract. They also need to talk to their tax people and find out how this is going to affect them on their taxes. And they might want to talk with their lender and see what's going to happen with their lending situation. While a short sale does have a detrimental effect on their credit, it's not as severe of a detrimental effect as an outright foreclosure, but it could take years to recover. This all has to be signed. This is for the actual listing agreement. This is so they understand the listing that a short sale is treated differently. And that just because it's short doesn't mean it's a short amount of time. Now, the third party is also typically going to require that the home still has to be maintained in marketable condition. If the seller decides, I got to sell it anyway, and they trash the house on the way out, and then it loses value, the third party can still retain the right to go after them for the loss of value. If you've ever shown a foreclosed home before, some of them are in pretty nasty shape, because once the seller finds out they're losing the home anyway. I've walked into homes where they tried to steal the appliances, including the built-in dishwasher. And they got it dragged halfway across the kitchen floor and decided it wasn't worth the effort and left it sitting there. Left garbage in the garbage can. Wet laundry still in the washing machine. Opened the front door and the smell pretty much pushed us out the front door. The most appalling part was that they had listed it as VA. I'm like, this is not meeting any minimum property requirements. The most extreme I've seen was an axe murdered house. I wasn't personally involved with it. It was in my wife's neighborhood where she grew up. It was a divorce situation that the home ended up going into short sale because the husband was angry that he was going to have to sell the home. And since the home was vacant, he'd moved out and she'd moved out. He went in on the weekend, dragged all the hoses into the house, turned all the exterior taps on and used it, and then broke all the handles off, turned on all the faucets inside the house and broke all the handles off. And then just went through and randomly knocked holes in the walls with an axe. And then an undetermined amount of time later, called his son and asked if anybody checked on the house lately. And he got there to find out the home had been axe murdered. Well, but it drove the market value, drove the resale value on it so low, it ended up in short sale. And the judge ordered that he be responsible to pay the wife for the lost equity in the home. Because it was through his actions, the home lost value. So if you're working with someone with a short sale, they need to help them understand they still need to maintain the property and still show it as well as they can. If they've already moved out because of moving on somewhere else, then make sure the property is still maintained. Yeah, in the long run, it'll only hurt them because if the lender decides to go after them for the difference in value. Okay, this is the short sale disclosure that goes out then as part of the purchase process. And this is to help the buyer understand what it means to define it. It explains the process for a third party approval, that the third party could reject it. There could be delays. The third party is going to continue to encourage offers, and the seller and buyer advised at any time prior to the third party approval deadline or the third party approval, the buyer or seller may cancel the proposed short sale. On the purchase side, the short sale addendum explains the same things. This then goes in with the purchase contract. It is required on a short sale that this go in. And it states the approval by the seller is conditioned upon third-party approval, and that the buyers agree to any third-party modifications to the REPC and acknowledge the third-party requirements by accepting the third-party approval addendum. They say because the lender is really in that seller position, lender could counteroffer. They may counteroffer with a higher price. They may counteroffer with different deadlines. Anything that could benefit the lender, they could counter. Now, this is to help protect the buyer and the seller, in that you can put a deadline in here as to when a deadline to receive the third-party approval. If it hasn't been received by that date, the REPC is considered canceled. That's a bit of a gamble on the buyer's perspective, because you really don't know how long the third party is going to take. If they meet once a week to sit down with their underwriters and review everything, it could take at least a week. If they meet once a month, it may take longer. That's a serious conversation to have with the buyer if they want to put that kind of deadline in there. The other difference is that the earnest money, you can mark it two ways. Actually, one of three ways. They can go ahead and provide it within the 4 days as the standard with the REPC, or they may choose no later than 4 days after they receive third-party approval. So they write the REPC out today, gets accepted by the seller tomorrow. If they mark the first spot, then they have 4 calendar days to get the earnest money just the way it would on any standard transaction. Or they can choose to hold on to it and wait until they receive notification that third parties approved it. Then the contract's really in the executory state, it's really live. Then they have to pay it. They have to understand that the seller retains the right to receive backup offers, and that there are some unique rights for buyer and seller to cancel under this type of contract. The changes may include, but are not limited to, adjustments in available mortgaging, financing rate, and terms. If the seller is able to refinance and get better terms and keep the house, they can cancel. Modifications of financial circumstances of seller or buyer may no longer meet either's needs. Buyer may find another property that's better. That one seems kind of obvious. Seller may receive additional offers. All of these are reasons that they need to understand. And then this is also an aspect of it. This modifies paragraph 24 of the standard RFC. Typically, we put, seller disclosure deadline is X number of days after approval. Well, this holds it until after third-party approval. That means you're not paying for an inspection, you're not paying for an appraisal, you're not doing any of those steps until after third-party approval. It's kind of counterproductive to pay for an inspection when you're not guaranteed you're going to get the house. So they need to know that as soon as we get the third-party approval, then we're going to start these steps. And like it says right here in paragraph 7, they may still be looking at other houses and find something else they like and just say, forget it, I'm done. All of this has to go in with the original offer. Okay. So there's short sale disclosure, this one in the middle, has to go to the buyer and the seller. So you take it with on the listing agreement, along with the short sale addendum. And when you're writing an offer, they need to get this and the short sale addendum. And this one's been around a while, since 2009. And there were a lot of short sales going on then. Okay, any questions about short sales? There's some speculation we may see them start to come up as the market changes. However, 2 years ago, when the market was still at its highest, momentum, 50% of Americans still had significant positive equity in their homes, and the percentage of those who had paid off their homes was more than 3 times what it was when the market adjusted last time. So even if the market were to drop, a larger part of the homeownership population could ride out a loss of 10% of equity in their home and still be in a positive situation. And with lending rates right now, 3 times what lending rates were 2 years ago, they've still got some strength that way. Getting a loan modification right now would be tough because you could be trading a 2% loan for a 7 or 8% higher risk loan. All right, there's our first short addenda. The other short addendum, this was created because too many agents were trying to do this on their own, and we were getting totally goofball responsive or addenda. This addendum is used in the event that the seller of the home needs to remain in the property post-closing, post-settlement, for more than 1 or 2 days, typically. This is an extended period of time. This was very popular. This gets very popular when the market is hot, and sellers would rather sell their home outright, rent it back for a month while they go buy another home, rather than have to disclose that the purchase of their new home is contingent on the sale of a home. It looks stronger when you say, I don't have to sell a property, I already did. But now that you sold it, you still got to live somewhere. So buyers were willing to let the seller remain in the property as long as there were some protections for the buyer. And they could make it work. Now, this states specifically it's only good for up to 59 days. Why 59 days?
Guidelines require property.
Lending guidelines, just like I said, Jason, require that the buyer take possession of the home within 60 days.
Sign documents, occupancy affidavit or something like that.
At settlement, they sign an occupancy affidavit that they will be taking possession of the property. So on the REPC, you can typically, it has the section where you put when do they take possession, either upon settlement, blank number of hours after settlement, or blank number of days. If you're going to be using this, then typically you're marking the how many over number of days. And then you're going to mark that there's a short-term lease back addendum on the where you mark that there are addenda. This allows the buyer and seller to negotiate what the rent amount will be for the term that the seller, now renter, is in the home. That's typically figured out by looking at what the mortgage cost is going to be for the new buyer. Or if the new buyer is in a rental situation, how much rent are they going to have to pay to stay where they are while their seller's still in the house? Okay, Jason, when a loan gets approved, typically how long after settlement, when is the first payment typically due?
So let's say if you close, say in May, it'll be July 1st.
Yeah, if you close during May, you've got the month of June and then July 1st. So if you can get this to work out so that it's before the first mortgage payment, great. But if the seller is going to be in there longer than that and your buyer now has a mortgage to pay, they're going to want to charge enough rent to at least cover the mortgage and their principal, interest, tax, title, and licensing. It allows, so you can determine what the deadline is, how much will be paid, and how it will be paid. Typically, paid by the seller to the buyer no later than closing in the form of is typically a check. And if one of those parties is the seller is going to shorten it, they need to give prior notice. So the seller's new transaction closes earlier than they thought, great, but you still have to give us written notice because you have to determine if that's going to be prorated, the rent is, and if it is, then the buyer has to figure out how much to send back to the seller. Utilities. This was a big problem before that agents were just trying to remember to list utilities in there when they were writing their own versions. This was added. This was an older form that got updated. If you notice it says that if no box is checked, it's assumed the seller will continue to pay for the utilities. The difficulty here is once it changes ownership, utilities have to be put into the name of the new property owner. So there's a whole explanation right here about after the seller moves out, making sure that once the final utility bill comes in, the buyer, now landlord, has to provide the seller a copy of the bill so the seller knows what to pay. Okay. And it's typically in the new homeowner's best interest to make that transfer very quickly. So they don't end up having to pay deposits again or transfer costs. They can negotiate a security deposit. And the description of then what occurs with the security deposit if there's damage to the property. Right of entry. This is the same as any landlord lease agreement. If the landlord wants the now buyer, new owner, wants to access the property to make sure there's no damage done to it, they have to provide 24-hour notice. You can't just randomly show up. Delivery of possession upon expiration of the rental period. we put a deadline up here. This is when we get to take the house. And we're going to skip down here just a little bit. We're going to skip a couple. If for some reason the seller doesn't move out on time, how much they're going to be charged per day for not moving out by the deadline. And you can make that a pretty significant. We've done some of these in the past where we've made it where the buyer's like, yeah, I want $200 a day. I want to make it hurt enough that the seller's gonna be motivated to get out. This is boilerplate. No alterations or damage to the property. That's worded exactly the same way it is in the REPC. But the former homeowner, now renter, signs that they will not do additional damage to the property or make any alterations to it. We had this problem come up with a listing I had. The first buyer fell through, but it was a family friend, and she let family friend move her kid in because he was going to move in anyway. And then it didn't work out, and we had to go through the eviction process for the family friend's kid because he wouldn't get out of the house. And in the process, he had started doing a remodel because he figured his mother was going to buy him the house. And so he started tearing the house all to kingdom come, including walked off with a wood burning stove. We had to go through the eviction process to move him out to get it sold. There's another case of if you'd listened to your agent the first time, we wouldn't be in this mess. You don't say, yeah, it's okay, it's a family friend, let him move in. Default on the lease back. This gives all of the same rules like a landlord would have. If the seller, now renter, defaults, either doesn't make the payment or in some way defaults on the agreement, what they have. What rights they have as a buyer. Liability and seller's insurance. So buyer and seller agree the buyer will not be liable for any damages directly or indirectly caused by any other occupant. That's like any rental agreement. Even though they don't own the home anymore, they're still living in it, and they have a raucous weekend party with their college buddies, and somebody falls through the plate glass window. Who's liable to replace the plate glass window? The new owner or the prior owner? So the prior owner, who's now a renter, broke it. Okay. That's why the seller is strongly advised to obtain their own insurance. Seller should be getting renter's insurance while they're still there. Buyer is already going to have property insurance on it as a requirement of the loan. Now, underwriting is going to see this. Underwriting may require that they get landlord insurance, the more expensive insurance for the term of the leaseback agreement, in the event that the people who sold the home but are still living in it do damage to the home while they're living there as renters instead of owners. Agency. This protects you. This in a nutshell says, once settlement is completed, everybody's been paid off, you own the home, my agency agreement with you is complete. I am not your property manager. So if Jason sells the home and Ryan buys it, and I'm Jason's agent, as soon as Ryan and Jason, the paperwork's signed and everything's done, Jason, you're the landlord, Ryan's the renter, I'm not your property manager. If you have questions, understand that I'll answer them as professionally as I can, but we no longer have a valid agency agreement because our agency agreement states it is considered executed and completed upon purchase of the property. Same for the listing agent. They're not the buyers. It's now between you two. You can then also put any additional terms you want to in there. If you're working with one of these, Amory has done a number of them. She can help with wording. I can help with wording. If we want to need to get really technical, you want to make sure you talk with someone who's in the legal background. Technically, at that point, we're practicing law without practicing law. This was designed really to cover just about all the major contingencies. But there may be some additional terms, like what happens if the buyer needs to now put their personal property into the property because they'd already made arrangements to move. Or they've got an RV, they need to get out of storage and park there. Things happen, things like that can happen that you can include in there what will occur. Okay, this is available. All of these forms are available on the MLS's website under their forms. You doing laps today?
I forgot you can't get through right there.
Oh, that's right. She closed the door and locked it. Okay. All right, I'm gonna do this. I'm gonna